Taxes can be one of the most intimidating topics for a new investor. The rules seem complex, the forms are confusing, and it feels like there's always a catch. Yet, understanding the basics of how investing and taxes work together is absolutely essential. Without this knowledge, you could end up sending much more money to the government than you need to. So, what kinds of taxes do investors face, and how can you set up your portfolio to be as tax smart as possible? Let's break it down together, in simple terms, on Invest Easy 101. When you first start working, taxes seem pretty straightforward. Money comes out of your paycheck, and once a year, you file a tax return. It's a routine. But as you begin to build wealth and invest, you quickly realize the tax system has many more layers. It's filled with specific rules, exceptions, and different account types. It would be impossible to cover everything in one conversation, but we can focus on the key ideas that every beginner needs to know. We'll cover the basic taxes on investments and explain the powerful tool of registered accounts like the TFSA and RRSP in Canada, or the Roth IRA and 401k in the United States. While the core principles apply everywhere, some details will be specific to certain countries, and I'll point those out as we go. Let's start with the foundation. What taxes do you actually pay as an investor? First, there's income tax. You already know this from your paycheck. In places like the US, Canada, the UK, and Australia, we typically have a marginal tax system. This means your income is taxed in chunks or brackets. The first portion of your money is taxed at a low rate, and as you earn more, each new dollar falls into a higher tax bracket. It's like filling a glass. The money at the bottom is taxed at the lowest rate, and the money at the top is taxed at the highest rate. Your overall or effective tax rate is an average of all these brackets. Now, it's not just your salary that goes into this tax glass. Certain investment income does too. For example, interest earned from bonds or savings accounts is typically taxed just like regular income, at your highest marginal rate. This investment income can even push you into a higher tax bracket. Dividends, which are payments from stocks, are also taxed, but they often get more favorable treatment. In many countries, there's a tax credit or a lower rate applied to dividend income to account for taxes the company has already paid. This makes them a bit more tax efficient than interest. Now, income tax isn't the whole story. The other major tax for investors is the capital gains tax. This one is based on your profits from selling an investment. A capital gain is simply the difference between what you bought something for and what you sold it for. If you buy a stock for $100 and later sell it for $150, you have a $50 capital gain. You generally only pay tax on your net capital gains for the year. So if you made a $50 gain on one stock but lost $40 on another, you'd only pay tax on the $10 net profit. The good news is that in many countries, long-term capital gains, often from investments held for over a year, are taxed at a lower rate than your regular income. This favorable treatment is a key reason to think about how long you hold your investments. So, income tax and capital gains tax are the two main taxes you'll encounter. While there are others, understanding these two gives you a solid starting point for making smarter, more tax-efficient decisions. Tax efficiency is all about legally keeping more of your investment returns. It involves two main ideas: minimizing the total tax you owe and delaying when you have to pay it. Delaying tax might sound like a small thing, but it's incredibly powerful because of a concept called the time value of money. This is just a fancy way of saying that money in your hand today is worth more than the same amount promised in the future. Why? Because you can invest the money you have today and let it grow. If you can delay paying a tax bill, that's money that stays in your account working for you for a longer period. So how can you actually become more tax efficient? There are many advanced strategies, but for a beginner, the single most important tool is using the right type of investment account. Think of an investment account as a container or a box where you hold your stocks, bonds, or funds. A standard taxable brokerage account, sometimes called a cash account, offers no special tax benefits. You pay taxes on dividends and capital gains as they happen each year. The real power for most people comes from registered or tax-advantaged accounts. A common starter account is the tax-free savings account in Canada, which is very similar to a Roth IRA in the US. This is a tax-exempt account. This means any growth, dividends, or capital gains that happen inside this account are completely free from tax. When you withdraw the money in the future, you owe nothing. This allows your money to compound and grow without the government taking a slice each year, which makes a massive difference over decades. Of course, there's a limit to how much you can contribute each year, which the government sets and adjusts. Another crucial account is the Registered Retirement Savings Plan in Canada, similar to a traditional 401k or IRA in the US. This is a tax-deferred account, and it works a bit differently. When you contribute money to an RRSP, you get an immediate tax deduction on your income for that year. If you earn $50,000 and put $5,000 into your RRSP, you'll only pay tax on $45,000. It's like getting a refund on the tax you would have paid on that money, which you can then invest. Inside the account, your investments grow tax-free. You don't pay any tax on dividends or capital gains year to year. The catch is you will pay tax later, but only when you withdraw the money, ideally in retirement. The huge benefit here is that you delay the tax bill for decades, and you might be in a lower tax bracket when you retire, so you pay less tax overall. These registered accounts are the cornerstone of a tax-efficient investing plan. While you'll ideally use both types over your lifetime, tax-exempt accounts like the TFSA or Roth IRA are often a fantastic and flexible place to start for a beginner. I know this is a lot of information, and the world of taxes gets much more detailed, but grasping these core ideas, the taxes on investment income and gains, and the incredible advantage of using special accounts is a major step. This knowledge gives you the foundation to make choices that let you keep more of your hard-earned investment returns, so your money can work for you as effectively as possible. Thank you for joining me today on Invest Easy 101. If this overview of investment taxes was helpful, please give the video a like. It really supports the channel.